Why is no one asking who's standing for delivery? Now, let's make an important distinction. Standing for delivery doesn't mean leaving COMEX, but it means standing for delivery where the warrants, instead of accepting a warrant where the exchange is basically says this is what you get and this is where it's at, the kind of warrants that are exchanged they're bi-party warrants where the numbered bars and the exchanges, the vaults where it's held, are determined by the exchange of those warrants between two parties. So we're seeing deliveries and metal, what's called loadout, leaving, but the deliveries in and of themselves are exponentially out of the ordinary. For my entire career, 36 years, less than 1% of contracts stood for delivery. We're seeing massive amounts stand for delivery.
June is always the worst time for mining stocks or metals. I don't know why that is, but you look at the 30-year chart and it's clear, it's available on the internet. People can go look at it for themselves. And then, the market usually goes flat July and August and starts to pick up in August, September, and usually December, January, usually the hot months for metals. We see it time and time again, and that's what we're seeing currently right now. They're part of the system. They're run by the banks. So the whole thing is a scam.
The paper silver market has faced structural strains as physical demand heavily outpaces paper contracts, with severe supply shortages from December through February, triggering major price movements as participants scrambled to secure tangible metal. Andy Schectman, a prominent precious metals expert and president of Miles Franklin, and Keith Neumeyer, a renowned mining executive and CEO of First Majestic Silver, emphasized that the biggest money in the world uses price as the ultimate tool of misdirection to accumulate assets at the absolute bottom. They predict that silver has officially established a permanent structural floor in the mid-$50 range and is highly unlikely to ever drop back below $50 in our lifetime. They point out that the massive volume of silver contracts standing for delivery on the COMEX is exponentially out of the ordinary compared to the historical baseline of a 36-year career. Over 39 million ounces of physical silver were recently loaded onto trucks and moved out of COMEX facilities, proving that major players are aggressively demanding numbered bars rather than accepting standard exchange warrants. This unprecedented drain on physical reserves demonstrates that massive entities are quietly accumulating hard assets, while the extreme volatility has forced a temporary shutdown across the U.S. refining sector due to exponential margin call pressures. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
That's a lot of silver that trades in the paper market every single day. And there has to be a physical supply to back those paper contracts. And we saw in December through February that there was not enough physical supply. And that's why the price did what it did, because people were scrambling for metal. And we felt it as a mining company, as I already pointed out. And, it's quite an interesting phenomenon. So all of a sudden, if you look at the COT reports now today, the short position that existed this time last year does not exist today, because we've woken the banks up. They took substantial losses from, December through February. And because that whole move, as I said, some 70 higher, was all of them short cover. They're part of the system. They're run by the banks. So the whole thing is a scam. It's just unfortunately the way it is. We as mining companies are at the mercy of the financial markets. It's the only industry in the world. There's one of my biggest beefs against the current pricing system is that we don't control the price of our product. If you're producing jeans or producing an automobile, you can fix the price of your product that you're selling at and make sure you have a profit. For us as a mining company, going back to 2012 when I made the triple-digit silver prediction, it took 14 years to hit triple digits, mind you, but fundamentally there's been no change in the way the pricing mechanism works. The banks still do the same thing, but today I think they've woken up. Asia has deemed silver a critical metal.
Yes.
The United States has deemed silver a critical metal. There's talk in Canada and Europe that also that's going to happen in those markets as well. We know the issue. Even if silver was $100 today, which it was, earlier, it wouldn't put a dent on supply. It's still not enough, because you need 10 years of that price before you incentivize the mining sector to invest the necessary capital to produce more metal. The mining sector right today is stretched at 850 million ounces. They can't produce more. regardless of the price. When I put my prediction out for triple digit silver,
He was the OG of this, by the way.
In 2012, and then the silver went straight down from the moment I predicted.
You
triple
took the
digit.
heat. You took it.
So a lot of people were quite critical, but it did eventually. And I was confident it was going to happen. It's just, I look at the numbers. I look at the supply demand fundamentals. If you look at it, we've had 6 years of deficits. It would take 10 First Majestics to be starting today to fill that gap.
That's incredible to think
10
about.
First Majestics? How is that even possible?
No. 10 Keith Neumeyers.
No, it's not going to happen.
February, we saw 4.1 million ounces of gold delivered on COMEX as the price got kneecapped. We saw 26 million ounces of silver delivered in February on COMEX as the price got kneecapped. However, now this is 18 straight months to where we are now of month over month over month over month deliveries on COMEX. But what was interesting about February, as far as COMEX is concerned, was that 26 million ounces were delivered, 39 million ounces, or 160% of what was delivered, got on trucks and drove away from COMEX. That's almost 3 million pounds of silver, about 2.9 million pounds worth, $4 billion, got on trucks and drove away. The bigger question is, who the hell did that? Who ran logistics? Who's been standing for delivery this month in June? 12, 13, 14 billion in gold. I don't know the exact number, but let's call it 13 billion stood for delivery in gold this month. Why is no one asking who's standing for delivery? Now, let's make an important distinction. Standing for delivery doesn't mean leaving COMEX, but it means standing for delivery where the warrants, instead of accepting a warrant where the exchange is basically says this is what you get and this is where it's at, the kind of warrants that are exchanged they're bi-party warrants where the numbered bars and the exchanges, the vaults where it's held, are determined by the exchange of those warrants between two parties. In other words, it's different than just accepting the warrants from the exchange. It's like between you, no, Kai, I want your bars, I want those number bars, I want them now. And so we're seeing deliveries and metal, what's called loadout, leaving, but the deliveries in and of themselves are exponentially out of the ordinary. For my entire career, 36 years, less than 1% of contracts stood for delivery. We're seeing massive amounts stand for delivery. And to me, it betrays everything else. At the same time, in the first quarter, China imported more silver than they ever have in the history of their country in the first quarter. This is as the price was getting kneecapped. And that's why the name of my presentation tomorrow here is Price is the Ultimate Tool of Misdirection. Because the biggest money uses that price to misdirect, kind of like Lobo was saying, who the hell is buying it? Who's buying it at the bottom? Well, there's someone standing for delivery who is using the price, I would argue, as a tool of misdirection and saying, thank you very much, we'll take this subsidy, and here you go. We want delivery, by the way, thank you. I think it's the Exchange Stabilization Fund, which is the U.S. Treasury, which is Scott Bessent, who understands gold very well, and silver. And silver was reclassified a critical mineral. He could argue gold is too. And if he argues it successfully, it does not need congressional approval to stand for massive deliveries. I think they're doing it and doing it by proxy through the commercial banks. And if I really had to guess and really take another level of speculation, I think they've worked out a deal with Tether as well through proxies. Bo Hines was Trump's crypto czar through last August, who's now the CEO of USA Tether. Tether's bought more gold than anyone in the world for the last couple of years except the Central Bank of Poland. They're taking all the interest they're getting from gobbling up our treasuries and buying gold. And they are at the center of the Genius Act, where the interest is not transferable, and they're buying all of this gold. Well, what if the U.S. government struck a deal with them and said, we want, they were in trouble by the Justice Department a few years ago. Where'd that go? Now all of a sudden it's almost like, here's what's going to happen. You're going to take all the interest, you're going to buy treasuries, and I believe ultimately that the U.S. government wants gold to go higher, Kai, for once, because of something called Triffin's Dilemma. And they want to be able to reshore manufacturing. You can't do it as a reserve currency. So you have to soft default on it by letting the dollar deflate or devalue. How do you do that? Let gold go higher, and you softly default on the dollar using proxies like Tether to help you do that. If I were to speculate, that's what I would say. There's a lot of these things that seem conspiratorial like JP Morgan manipulating the market all those years, people would say, that's not, JP Morgan traders couldn't keep their mouths shut long enough, like Doug Casey said. Evidently, they could, and they paid a $920 million fine for manipulating the metals market. Fine line between what is conspiracy and what is reality.
Absolutely. Like with the actions in the Middle East and Venezuela at the beginning of the year, though, the decline of the US dollar was slowed down, maybe even stopped for now. Like, how does that fit the narrative? Because all of a sudden, the petrodollar is gaining strength.
It did for now, but the US dollar, the treasury, more so, is based on trust. And I think the erosion of trust in our system, in sanctions, in tariffs that are actually sanctions pretending to be tariffs, in our fiscal irresponsibility. You can see short-term movements within a longer-term trend. But if you think about it, what really makes the dollar strong? What really makes the dollar strong? And I think much of the world is using that strength to quietly exit and buy things of value. You're seeing it all over the global south as they're buying up not just precious metals.
The silver market has historically experienced a flattening trend during July and August before picking up momentum in September, with the winter months of December and January typically serving as the peak period for metal price increases. Commercial banking entities have historically maintained massive short positions to manage and suppress the price actions of these core commodities. However, the severe supply strains witnessed at the start of the year inflicted heavy financial losses on these institutions, fundamentally shifting the traditional short-covered dynamics of the market. Furthermore, global superpowers like China have dramatically scaled up their physical silver imports to record levels, treating the asset as a highly critical mineral. While paper markets like COMEX continue to dictate day-to-day spot pricing, global central banks are successfully establishing an unbreakable floor beneath the metal. The refining sector continues to navigate a 16-week backlog as the broader industry slowly works to normalize regular trade operations. Now, let's get back to the interview.
It was at VRIC, I remember when it hit 120 and I'm looking at my phone and, everyone's just, smiling and high-fiving and so on. But I knew it was just getting a little bit too much. Unfortunately, the banks were in a lot of stress at that point. Once it broke through $50, it went straight to 70 basically. And that was all, real physical buying, which took it there. The move from 70 or 80 to 120 was all short covering. And that's when the banks were in trouble. And we were getting calls from places in Europe and throughout the United States looking for physical metal. We did a trade with one group out of the US because we're friends with them, and we gave them some physical because our vaults are, always have silver in them. So, we could do quick transactions if we need to. And we took advantage of the price at that time. And obviously the buyer was quite happy we did that because we took them off a difficult situation, I understand. But, the paper guys got, they got to a point where they had to get together and knock it down like they always do. But what's happened is that we're in a new price environment. I look at copper very similar to how I look at silver. And, when I was running my copper company prior to First Majestic in the 90s, I put the company together. We did our PEA at $1.25 copper. And that was in 97, 98. And then, copper hit 60 cents in 2000 and we're going, what the heck, and we really struggled for a couple of years. From 2004 through 2008, copper hit 450. It corrected to about 250 and now it's at 5. So it never actually retraced the entire move. And that's what we're going to see in my prediction on silver. So we're not going to see a full retracement. We're now basing out at these levels. And who knows, I think the bottom is in. June is always historically the low. Now, I just had a conversation with an investor a few minutes ago. If you look at a 30-year chart, you see June is always the worst time for mining stocks or metals. I don't know why that is, but you look at the 30-year chart, and it's clear, it's available on the internet. People can go look at it for themselves. And then, the market usually goes flat July and August and starts to pick up in August, September, and usually December, January, usually the hot months for metals. We see it time and time again, and that's what we're seeing currently right now. Traders tend to follow trends. You're talking about young people behind computer screens that don't have a clue about what they're trading. All they're doing is trading charts. So they know, to get short in February, March. They know to cover their shorts in June, July, and then go long. And they do it all the time. And that's just the way the market works. We're not going to see sub $50 silver, I don't think, in our lifetime. That's maybe sounds like a bold prediction, and maybe intraday it might break 50. I doubt it, but we've been basing out here in the mid 50s for the last couple of months now. We got through over 60 again, and it looked like it might have got up to 65. It didn't obviously get there, but we're sideways market for a couple of months, and it's healthy. The world needs to wake up to the fact that silver's $60 and it's never going backwards. And the demands for the metal are real, and the demand hasn't changed from whether it was $30, $50, or $120. The physical demand is still there.
Central banks are moving the price, period. As far as I'm concerned, the biggest money in the world is moving the price, setting the floor. But the COMEX market sets the price. The central banks set the floor. The paper market, which is annoying as can be, and one of these days, what you see yesterday, the Hong Kong exchange opened up. Well, it opened up last December, but their price-setting exchange opened up. All of these exchanges never set the price. They're going to set the price in Hong Kong and Singapore to challenge London and the United States, because, even the things that they're doing, they gave in Hong Kong 1 year worth of free dollar lending, their dollar-based gold futures account in Hong Kong, and they're trying to incentivize very tight spreads the world to trust China and Singapore and these other countries that will attempt to set the price and wrestle that away from London and the United States. But the real answer is, for now, until it breaks, it's the positioning on COMEX. It's the tail wagging the dog. The underlying commodity should set the price, not the futures contract. And I think much of the world, A, understands this, B, is annoyed by it, and C, is using it against the United States. They're not going to bitch about it while they're accumulating. If the West is dumb enough to suppress the price while the rest of the world's buying it, let them do it. But at some point, as you see open interest has fallen to almost nothing on COMEX, the players are going to pick up their toys and find another sandbox. If you're a refiner with $50 million in silver that you've paid you for everything from doré to shot to junk silver to flatware, well, it takes time to break that stuff down and get rid of the impurities. Like if you're doing flatware, a knife that's sterling, the blade is made of stainless steel, the handle is made of plaster with a thin wrapping of sterling on it. So you got to break that. It's labor intensive. It takes time. So they paid you $50 million for all this silver. It takes time to do it. But if they do that, they have to short the amount they've paid out so that they're market neutral. In other words, they paid $50 million for the silver. They need to short it on paper so that if the price of what they bought goes down, they're not out, because it's going to go up commensurate on what they sold short, so it balances. Well, not only was the price going up so fast that their short position was getting margin called, because if you short and the price goes up, it's going against you. So they were getting margin called on their short position, but the cost to margin was going up exponentially. So the entire refining industry in the United States all shut down, and we're 16 weeks back ordered. Well, we're just starting to normalize, and the reason that's a problem is there's only, I don't know how many companies hedge, not a lot, just the bigger ones. The rest of them don't hedge, and with the price moving that fast, well, they were getting hammered. And if they didn't have the ability with some of the stuff that they would take in, be able to send it to a refinery, which was a big source of liquidity in the market, all of a sudden, the bid prices just collapsed. And I've never seen anything like it in 36 years, ever. Companies like mine either experience massive increases in margin cost, or if you weren't hedging, I'm talking to the point we have 2 million ounces of silver. In December, it cost $15,000 to hedge 5,000 to protect it. Well, you see how much money you have to have in a margin account, but how about at $54,000 per 5,000 ounces hedged? You have $50 million in a margin account just sitting there as collateral, or you don't have a big inventory. If you don't hedge, you're dead in the water. If you just bought back 5,000 ounces of silver from someone and the price went from 120 to 60 in a few days, you're out of business that fast. And so it created damage that I've never seen in 36 years. It's beginning to normalize, but not quite yet, but I think we're on our way there.
The pricing framework governing the mining sector remains heavily detached from actual production realities, since mining corporations do not possess the autonomy to fix retail prices to guarantee corporate profit margins. It traditionally requires an extended decade-long window of high market pricing to properly incentivize mining firms to deploy the massive capital expenditure necessary to uncover and produce new mineral supply. The current global mining infrastructure remains strictly capped at producing approximately 850 million ounces of silver annually, rendering it incapable of boosting immediate output regardless of how high spot prices climb. Because of these immutable supply and demand constraints, the traditional floor for silver is firming up near the mid-$50 range, indicating that the asset is highly unlikely to drop below $50 again in our lifetime. Young technical traders behind computer screens continue to execute short-term chart trends, but the broader global market is actively waking up to a permanent structural shift where physical metal demands remain completely insensitive to short-term paper price manipulations. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.